But let's just kick it off with the market, because that is really a key story. Julia, in terms of these triple-digit gains, 110 points almost stronger today, 1.9%. Talk us through it from your perspective.
It's an absolutely incredible day for the market, and it's all on the back of the US Federal Reserve not being in any hurry to raise interest rates. So we have a look across the market, every single sector traded higher. If we have a look at the top 20 blue chips on the Australian market, every single one of them traded higher. The best was Westfield, up by 5.8% in one single session. Wesfarmers was one of the worst, and Rio Tinto the worst, with a rise of just 0.1%. But if you have a look at low interest rates, the type of companies that it really benefits are those companies with a big pile of debt, because it makes that debt cheaper, as well as those companies giving high dividends, which makes it attractive for retail investors and investors in general. So if we have a look at those two things, a high level of debt and a high dividend yield, that tends to be in the utility sector as well as the property sector. So it's unsurprising that today on the market we saw the property sector, the utility sectors, the best performing sectors on the market. The banks also worth a mention. It was an absolutely record-breaking day. ANZ, Commonwealth, Westpac, all seeing all-time record highs, massive gains there. We also saw CSL hitting an all-time record high, as well as Transurban. So a fantastic day on the market, all on the back of expectations that this environment of low interest rates will be around for much longer, and the type of companies that benefited were the highly geared ones, those with high levels of debt, and the high yielding ones.
Not yield, but looking at CBA at these levels, do you get a little bit nervous thinking perhaps take some profits?
CBA is worth $150 billion. That's a massive amount. It is the 10th largest bank in the world. It's bigger than UBS, it's bigger than Goldman Sachs, it's bigger than Morgan Stanley, it's bigger than BNP Paribas, Royal Bank of Canada. So it's been an absolutely amazing run for these banks. And as long as we have this very strong residential housing market here domestically, combined with lower interest rates and falling interest rates domestically, and low interest rates in the US, I think the banks will continue to be in high demand. The problem becomes when you start to have a look at a bottoming out of that interest rate cycle domestically, and you start to see rates rise again. Now that's probably not going to be for some time, which is why the banks are doing so well. But altogether, you'd have to say that these high yielding stocks are highly valued at the moment, and they are looking expensive, but they're not trading because of their high valuations. This is all on the back of calculating low interest rates. And if you do take profits today, the question is, where do you put it? The cash rate here in Australia is 2.25%. There aren't many areas to put it at the moment, and that's really why the yield trade is looking so overcrowded at the moment. There are a lot of people on the same trade, but as long as the US Federal Reserve is happy to keep rates low in the US, and we're seeing falling rates here domestically, it's hard to see where these investors are going to go.
Mike, okay, let's ask Julia. Julia, in terms of your view on Myer today, obviously the stock down 10%. You know, is this a time for Richard Umbers to perhaps, as they like to say, clear the decks?
Well, that's the market's thinking, I think. There's two things that really drove that fall in Myer's price today. First of all is that the full-year guidance was lowered. Consensus was at $89 million, and we've seen full-year guidance at $75 to $80 million. So you are going to see valuations and targets on Myer being adjusted downwards. And then secondly, this strategic review, the fact that we do have a new CEO, that perhaps we will see a clearing of debt, some write-downs, closure of stores. Of course, all of this costs money, so the fear is that there is a bit more bad news to come from Myer in terms of this strategic review. So it does look like the retail environment's still very difficult out there. You know, this year we've heard from Oracle, we've heard from Myer, we've heard from Kathmandu that times are difficult out there on the market. The only ones really bucking the trend are maybe some of those electronic retailers that have really benefited from some of those new technology products coming to the market, like the iPhone 6. But in terms of retailing, especially clothing retailing, it has been quite difficult.